For anyone that has bought a home over the last couple of years, since pretty much mid 2022, up through even today, one of the questions that they keep asking, secondarily to when do I get to move into my new home, is when can I refinance? So I was talking with a past client yesterday. We were just kind of going over those options and those questions, and I thought it might make sense to share a little bit about that with you. If we haven't met, I'm Rebecca, aka the Mortgage Mentor, and I'm here to teach you everything that I know about mortgages and real estate so you can make smart, confident choices. What I covered with her and what I'm going to cover with you are the two types of refinances, what all is involved, and how to make sure that you're making smart choices when you do refi. In general, there are two main types of refinances. There is what's called a rate term refinance and a cash out refinance. A rate term refinance is really just there to either change the rate, the interest rate, or the term, the number of years that you are going to have on the mortgage. So for example, if you have a 30-year mortgage at 7.25% and you refinance to 6.25%, that is for the interest rate. Now, you also might refinance from a 30-year to say a 15-year. That's dealing with the term, or you can do both at the same time. So one of the things to keep in mind is that that is a new mortgage. So even though nothing's changing with your house, it is a completely new mortgage. It does start over at that 30-year or 15-year mark. There are some lenders that do have options where you can have off numbers. So for example, let's say you've had the mortgage or you've had the home for 3 years and you want to refinance. Maybe you don't want to go all the way to a 25-year term. Perhaps you want to do a 27-year refi. That can happen as well. And then that just makes sure that the principal and interest portion of your mortgage payment is allocated correctly to pay the mortgage off in 27 years. The second type of a refinance is called a cash out refinance. And that's where you're actually borrowing more than what your loan balance is. So that's where you are taking money out basically from the equity that you have in your home. And equity is the difference between the loan balance and what your home is worth. In general, for a cash out refinance, you can go up to 80% of whatever the home is worth. If it's a rate term refinance, then depending on the loan type, but in general, you can go up to 95% of what the home is worth. So when you're doing a refinance, you're going to have standard closing costs. They might be a little bit less than when you bought your home, but like I said, since it's a new mortgage, you pretty much will have the same closing costs. So there's going to be an attorney or a title company involved. There may or may not be an appraisal, because there are options where you don't have to have an appraisal for a refinance. But let's say that there is an appraisal. You're going to still have your standard title fees like title insurance, things like that, lender fees, credit reports, all of those things. And then you are also setting up a new escrow account for your taxes and insurance. So the portion of your mortgage payment where you're paying a 1/12 of your taxes and a 1/12 of your insurance into an escrow account that's tied to your mortgage, that would be set up again. So when it comes to refinancing, what happens is we're going to, estimate what the loan balance needs to be to cover your current mortgage payoff and any closing costs. As long as we're not going over those loan to value limits, the 80% for cash out, the 95% for rate term, you can roll closing costs into your loan. Now, sidebar, if it's one of the loans where you don't need an appraisal like a FHA Streamline or a VA IRRRL, which is interest rate reduction loan, then you can't necessarily roll those closing costs into the loan. So that is something to consider. But let's talk about a standard refinance where you're having an appraisal and you're rolling the closing costs into the loan. One of the things that people will think about when they're trying to decide how to handle those closing costs, I would say that the majority of my clients, they tend to roll those closing costs back into the loan because they don't want to bring the money to closing, and it doesn't really change the payment that much. So if you want to bring the closing costs, if you don't want to finance the closing costs essentially, then usually what people will do is look at how much do I have in my current escrow account? How much do I have in taxes and insurance reserves? Because when your mortgage is paid off through the refinance, that is refunded to you. That's your money. So you get that typically within 30 days after closing. A lot of times it's faster. The other thing is that for most situations, you are going to be skipping a mortgage payment. So for example, if you close in June, you wouldn't have your first payment due until August 1st. So between those two amounts, sometimes people will choose to have their closing costs or try to make the closing costs close to those amounts. So then they're not increasing their mortgage loan balance any more than it is right now. And they're not necessarily coming out of pocket with money that they wouldn't have already, right? Because of the skipped mortgage payment, they're being reimbursed from their escrow balance. So the way that it works as far as kind of how things time is, again, first we're going to start with what you owe right now and how you want to handle the closing costs. We're going to estimate the home value based off of, what you see that sales are going for in your neighborhood. I have access to a couple kind of online value estimators. They can't replace necessarily the work of an appraiser, but they can get us fairly close. Let's say that you have a loan that had mortgage insurance. If you reach that 80% loan to value where you have 20% equity, as long as we're refinancing into a conventional loan, regardless of the previous loan that you had, then in addition to potentially dropping the rate or changing the term, we also might be able to drop that mortgage insurance. So that can further kind of compound those savings of a refinance. So once that's done, we estimated the value, we know what the loan balance is, we're setting up the new loan amount, then we're going to get the appraisal ordered and order the payoff for your loan. So keep in mind that whatever balance you see on your mortgage statement is not what the mortgage payoff is, because the payoff is always going to include interest through the day of closing plus a couple days cushion. So there's going to be that cushion there as well. And depending on the timing of the closing, it may even be possible to roll your next payment into that payoff. And then you actually kind of get to skip 2 months mortgage payments out of pocket. So there's a lot of strategy in there that is different from when you purchase, because it's not, we can be a little bit more flexible sometimes with the closing date, because it's not like it's something that you've negotiated to be specific with the seller. Also, again, we can usually make a refinance fairly low cost. Even though if you do have to front the cost for the appraisal up front, it may even be possible to get a little bit of cash back at closing to cover that as well. All of that to say, a couple things that you want to keep in mind to make smart choices when it comes to refinancing is a lot of people will ask, when is the right time to refinance? And that's a very personal choice, because if we're looking at a rate term refinance, that can be fairly mathematical from the standpoint of what is your payment now, what is it going to cost to refinance, and what can the new rate be? So I'll come back to that in a second, but that's fairly simple. When we're talking about things like doing a cash out refinance, does it make sense to do a cash out refinance, or do we do a second mortgage or whatever? It really depends on what you're going to be using that cash for. So for example, some people, who maybe have these super low rates that are even, back to kind of 2020, 2021 rates, but have higher consumer debt through credit cards or cars or other things, they really are very concerned about keeping that super low interest rate on the house. And I understand that, because who would want to let go of that interest rate? But when you look at the other accounts and maybe in the 20s or the teens, the interest rates that's being charged on those other debts, and you include that kind of as a household debt picture, sometimes it may make sense to refinance even if your rate goes up for the cash out portion. So that's one thing to consider is, are we being as smart as possible with your money? Now, when it comes to when do I refinance, in general, usually depending on the loan amount that you have, right? The higher the loan amount, the lower difference you really need between the rates, meaning going from say 7 to 6.5 would mean a lot more to someone if they have 400, 500, 600,000 loan balance than if they had 200 to 250. But in general, you want to start to think about refinancing when rates are around 0.75 to 1% lower than they are right now. And again, it's very personal because it depends on not necessarily just, can I save money, right? Can I get a lower interest rate? But there are two important questions. What is it going to cost me to refinance? And how long do I think I'll stay in the home? So not necessarily how long do I think I'll keep the mortgage, but how long do I think I'll stay in the home? And the reason that that matters is, let's say that, rates are, these are not rates, I'm not quoting these, I'm giving all the legal disclaimers here, but let's say that rates are at 6. Right? So you have a 7% rate, rates are at 6, sounds great. But then you think, oh, well, can I get lower? Can I pay more discount points? Could I get 5.75? Could I get 5.5? You could, and you will certainly pay a lower payment, but how much more are you having to pay in terms of discount points, additional closing costs in order to get that rate? So a lot of times the conversations that I'm having with clients as far as what is the right strategy and timing for a refinance is going to be around that. How much are we saving per month in the payment? And how much is it costing you to get this mortgage? Because again, remember, we'll have the escrow refund. That helps. And we also have the skipped mortgage payment. So once we go beyond that, how much extra essentially are closing costs affected by the rate that is chosen. So to explain that in math, because I think in math, if let's say that the discount points that you have to pay are $6,000, right? Loan amount $600,000, you're paying 1 point, discount points are $6,000. And then how much are you saving per month? Well, let's say that you're saving $500 per month on your mortgage. That's a pretty good deal because that means that you are going to recoup the cost of the refinance in essentially a year. So if we're looking at that and my client's saying, hey, this is our forever for the foreseeable future home. We love where we live a school district, the walkability, our neighbors, all that kind of stuff. We think we'll probably be here 5, maybe 7, 10 years. Then that would absolutely make sense. Now, if it's a different situation, and let's say that you're having to spend $6,000 to only save maybe $100 a month. $100 is $100, but it's going to take you so much longer. It's going to take you 60 months, almost 5 years to recoup the cost of the refinance. So that's why when we're talking about a refi, it's not just the rate. It's the rate, it's the purpose for the refinance, and it's also what it costs. So hope this helps if you are considering a refinance or just to understand what do you need to be on the lookout for as far as when a good timing is. And of course, as always, if you have any questions, please leave them in the comments, like, comment, and subscribe.